Hey, it's Lily with Monitorbase, and we're here with our CEO, Louis Zitting. Thanks for being here today, Louis. We appreciate you.
Thanks for having me.
Of course.
Having me in the organization anyway.
We're going to talk about some changes in the market today. So we wanted to ask you, Louis, where's the market headed? Where are we seeing things going?
Obviously originations are going like crazy. There's a bit of slowing. And a lot of this isn't news to mortgage people, but we'll just kind of recap. Inventory's low, so there's still a high amount of transaction happening, but there's just not great inventory for the first-time home buyer. So for a first-time home buyer, that's not great, but it's still pretty good volume, good purchase volume. And then refinance volume is still going, slowly tapering off, and that's really just kind of shrinking the population of refinanceable loans that are out there to do as the rates have stayed low for a certain amount of time.
All right. And what do you think will happen with purchase versus refi volume?
So without trying to predict the future, kind of, what seems obvious is, refinance volume will slow down, will continue to slow down. There's just, the transactions are shrinking, more and more are getting refinanced. Now, there is a great amount of people that could have but haven't taken advantage of the refinance market in the past year with the pandemic. There's a lot of credit issues for people that were in the type of jobs that didn't go crazy. And so there's a lot of people that really were held out of that. And but I think as long as rates stay steady, there's this constant migration of credit as people get back to their jobs, come out of forbearance, make payments, and just solve those underlying financial issues that may have come up in that process. So that can really kind of extend refis, not at the rate that they've been doing it, but if the rates stay sort of flat for a little bit, then that'll keep those going. Cash out, that's kind of a big subject, and we can chat a little more about that. I don't think, until the rates start coming up, which, soon, however long soon means, it really kind of depends on, the Fed and what they want to do. I think there's still good refinance volume to be had. You just got to kind of cherry pick them.
So you said you wanted to talk a little bit more about cash out refinance?
Yeah, so that's something that we see continuing refinance opportunity, even if the rates bump up some. There's so much equity being created in the last 2 years that that's a lot of cash that was created, and we were sort of surprised to not see that picking up more than it is until we kind of looked into the data and found that if you look into credit union and banks, savings deposits are up 20% from a year ago. So there's a spike in savings with all of the stimulus, PPP loans, and in some markets people just blew up. I mean, I know people in the retail clothing industry that just were slammed and busy, and obviously autos going like crazy. So there was a lot of cash created, and so overall there's much more in deposits, which means borrowing money is the opposite of having cash in the bank. So if people have cash in the bank, there's less consumer loans, there's less need for cash out in the short term. But that's short term, and if you look at the cycles of savings in depositors' accounts, it's just goes like this. People figure out how to spend that money. So that's cash out is picking up, but I think that can continue to pick up as those people spend the $2,000 to $3,000 extra that's in their savings account. start to use credit cards more. They want to do a home equity line. Once building costs come down some, you can use a home equity line to do a remodel, and a lot of people are just kind of holding off. So that need for cash isn't instant, but I think will definitely pick up over the next year.
All right, thank you. Is this a kind of market that we've seen in the past, or have we seen this type of market in the past?
So it's obviously different than we've seen in the past with, the pandemic changed a lot, and we have seen low rate markets in the past, and we've definitely seen refinance markets. So there's some different factors here than, like the 2008 crash. It's very much different than that. This isn't necessarily different than a refinance market or a low rate market changing and going back to a high rate market, right? I think some of the things that are obvious are rates won't stay low forever, so they're going to come up. And so what happens when rates start to come up is, during the low rate time, everybody's busy with purchase and refi, so they hire, underwriters, processors, loan originators. And then as soon as that starts to slow down, they want to keep that team. They've built and trained this team. They want to do whatever they can to keep that production up. So, sometimes you'll see margins shrink, and people trying to extend the inevitable of there's just going to be some less volume. So I think that'll happen, and we've seen that many times throughout the years where rates go up and then, people still try and do a ton of refinance marketing, try and keep that volume up, and then, eventually got to realize we've got to do some quality marketing. We've got to get more efficient in order to keep up this kind of volume. So no, I don't think it's going to be that much different besides maybe the size of the volume. I think we're going to go through a little bit of a slower period as things adjust, because when rates come up, the refinances go down, and then that will affect home buying and hopefully affect the inventory, which will help people get back to their purchase markets and building those relationships back with their agents that they probably neglected. So I think that whole thing will happen again, and it's not that scary. It's just really, it's kind of like a 6-month adjustment period that we've seen in the past, and loan officers need to see that that's coming, prepare for it, and realize you've got to change how you engage with your customers and start reaching out and building relationships with customers and agents again. And then volume will pick back up of purchases. And then there's always bumps up and down in interest rates. So there's always these interest rate opportunities that happen, because anytime the rates are up at a 3.5, there's still a 4.5 on the rate sheet. And for some reason, people are getting those, whether they're paying all their closing costs and taking a higher rate, or there's some builder lender kind of relationship. So as long as, during those times when the rates come up, that kind of pauses refis, but then as they bump around, there's just always refinance opportunity.
I love that. What should mortgage companies be doing right now to prepare for market changes?
So really, like I've been saying, let's get efficient. How do we get 3 or 4 more deals per loan officer per month than what's just coming at them because of low interest rates, or refis from friends and family and everywhere.
What should mortgage companies be doing now to prepare for market changes?
So we've seen this a lot in the past too. Usually loan originators aren't thinking too far ahead. They've got their closing transactions. They're so head down busy in these kind of times that they're not really building marketing plans, or, what am I going to do if I have 2 less loans next month until that starts to happen. So, but we do see a lot of mortgage companies looking ahead and saying, hey, I always see, there's going to be changes. It's obvious. And I think it's really just, get efficient, get back to your relationships, get people focused back on the realtor relationships, figure out, we've all built these great big databases of people that we've talked to over the year, and there's going to be transactions in that. So, focusing more on your database of people that know you, reaching out more, and really just, back to what work was like before the rates came down and everyone was slammed.
All right, I love it. Thank you. An additional question, what should Monitorbase users and companies be doing now to plan ahead for a shift in volume?
So for our users, I think, again, they've been so busy that they probably haven't updated their prospects in the system unless they have a good CRM integration that's constantly pushing those in. They're set. But kind of go and think back and say, what other customers or contacts have I met since I last updated my database, and get that all updated, because there's so many little transactions and different types of transactions that can come out of that. That's not just the normal busy life of refinance volume. They kind of got to cherry pick in there what's happening. So updating their database, reach out to those alerts. We've seen that a lot of people through the last year have kind of had that on autopilot, and it's driving inbound calls and emails, which is great because they didn't have time to reach out. So it was still, trickling opportunities on them. But now they can get logged in, look at their alerts, call those people up, do some of that kind of prospecting, and at least start to get that cycle into their weekly routine, at least, of calling 3 or 4 people and reconnecting. And that can help, with if you got 2 or 3 loans that you need to keep up your current volume. It's pretty easy to accomplish that with a couple phone calls, emails, workflows out of your CRM to follow up to your alerts, things like that.
Yeah. An additional kind of follow-up there, are there any alert types in particular that users should be paying extra special attention to? Any predictive events that would be particularly of use?
Yeah, so, migration's more important now than we think it's been in a long time because of the pandemic and financial troubles that people went through, and also people coming out of forbearance. And so if they don't have migration on, they should definitely get that turned on for anyone that, and it can really be their whole database, because, it doesn't need to be people that have actually declined. There's so many people in there that didn't reach out because they knew they were in forbearance, and they knew they, were deferring payments on their credit cards or whatever that might be. And it's hard to guess when they're going to come out of that, or, have a good 12 months clean mortgage history and up to date on all their payments to where their score pops up. So yeah, definitely migration. And then in the predictive alerts, focusing on the cash out types. Still first-time home buyers, I think people need to really not neglect the first-time home buyers. Kind of the story is we can't really help those guys because a lot of them, the prices just came up and they can't afford a home. Well, that's not going to be the case with everyone. And if that's the general thought, then that means those guys are getting neglected. So you can build those relationships now and, use those first-time buyers, even if they're not quite ready yet, but they might be in 6 months, to refer to your referral partners and say, hey, these guys are going to be ready. It's a first-time buyer, and I'll keep them in the process, but, I just wanted to share this relationship before they could find somebody else. And so that's a lot of value you can provide to referral partners. And if you wait until they're ready, then they've probably, they've got all that time to find an agent. So it's that's kind of a nurturing tool, but if we know they have the intent, then we should be watching them. You should be in contact with them, say, how's it going? What are you doing about a down payment? Okay, let's do this. What do your credit card balances look like? To just build that pipeline of first-time buyers that slowly will trickle out, and they'll find a home as inventory changes, and hopefully builders get back to being busy as supply or material costs come down. Hopefully that helps, and yeah.
I love it. All right. Anything else you'd like to add?
No, I think that's it. That was kind of a lot. But I'm really excited. I think this, everybody's had such a great year with volume. And even with if rates come up and things slow down, everyone can kind of have a breath of fresh air and go back to normal. But we've got great tailwind with, the demand is still high. If demand's still high, then it just kind of needs to meet with the supply, and that'll keep people going. We don't have a 2008 kind of scenario where everybody has two homes. So I think there's volume to be had. It's just you got to be efficient and be able to needle those out.
Amazing. All right. Well, thanks for joining us today. If you have any questions, email sales@monitorbase.com.
Okay. Thank you, Lily.
Thank you.